What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is May 19th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to spend some time to talk about a critical measurement for Bitcoin that practically no one is watching at the moment. It has to do with answering a big question. Is Bitcoin the leading asset? Is it the asset that people are turning towards during these times of uncertainty with Fed monetary policy, inflation, and the broader global economy, and a pending recession? Or is it starting to lag? Are people turning away from Bitcoin and seeing it as a risk-on asset? This is a critical question we must try to answer before we can even start to ask whether or not we are in a new bull market. In fact, it's imperative to do so. We've got a lot of things to dive into in today's video. We'll also be diving into altcoins and the broader stock market as well. So if you guys happen to enjoy the rambling, consider dropping a like. It's one of the best ways you guys can support the channel. And let's go ahead and kick off the conversation. All right, I want to go ahead and start by just taking a look here at Bitcoin's price. As you all know, we are getting very close to being at the turning point where Bitcoin's price could be setting up for that short, where we're going to get a flip on the weekly time frame on our key momentum indicator that you guys can get access to within the Dash report down below in the description. But we have a lot of people in the Dash report like ourselves who are starting to potentially prepare to make that position. In the report, we're talking about as well about what kind of methods. We just did our mid-month webinar back a couple days ago about how we are planning to actually short Bitcoin, what vehicles we're going to be using in order to do that, as a lot of us are from the United States. And so that's a big thing that's on our mind right now. But we're not just analyzing price here. It's one thing to have a couple trusted indicators, to have certain principles that you apply in technical analysis, but there's one key chart that I think you guys should really keep on your radar, because over the past couple of months, the narrative that has been driving Bitcoin is that we are going to go back to Bitcoin being the top performing asset. It's going to be this kind of conduit for liquidity to come and arrive towards and drive up Bitcoin's price, because essentially people are running out of the traditional financial system. People are going into Bitcoin and crypto as this supposed safe haven asset. That's at least the narrative we've been told for the past couple of months since back in March. But you all know we've taken a look at the dollar-based liquidity and stable coins. We've taken a look at the market order flow through our partner toolbook now. And at the end of the day, we're not seeing this. In fact, price action itself is not showing this. But something that's even more damning is something that the vast majority of traders, I would say over 98% of traders or investors, don't utilize in their trading strategies. That slowly exposes the fact that Bitcoin is not the top performing asset by and large. The top performing asset is technology stocks in the AI space right now. And the best way to visualize this right now is to take a look at ratios. Now, for those of you who have watched the channel potentially as far back as 2017, we talk about ratios every couple of months just to remind people about how powerful of a tool it can be in understanding which assets are leading. Now, it is important to note here that comparing Bitcoin to a lot of other assets might get a bit murky and sometimes may not hold too much relevancy, especially when you are in the midst of a massive bull market. Essentially speaking, if we are in one of those traditional crypto bull markets where Bitcoin's going to multiply many times over, the ratio of Bitcoin against other asset classes, especially over a longer term, really doesn't help us too much. However, in the near term, it is a great indicator, and over the very long term, in answering a big question, and that is whether or not Bitcoin is still the leading asset. Is it the fastest horse in the race, so to speak, that is going to continue giving you the best portfolio returns, having your capital allocated to Bitcoin versus other assets? And that's a very important question we got to ask ourselves here. Now, Bitcoin over the past couple of weeks, pretty much about a month ago in mid-April, has been slowly declining from around $31,000 at its relative peak. And the question we have to ask ourselves is, how are the NASDAQ and the S&P 500 and the Dow Jones doing? How are these other stock indices doing versus Bitcoin? Well, as much as we would generally expect that during a supposed risk-on or optimistic window of time that Bitcoin is expanding alongside other risk-on assets, the thing is that Bitcoin is not doing so. Since back in April, we've seen the ratio for the Bitcoin to NASDAQ ratio decline from around 2.5 to 2.1. This is basically on par with where we were back between January and February. And this is again why looking at the ratios can give us even more information. While it may look like we're at around the same price range we were back here in March, we're pretty much on par with the performance of the Nasdaq since as far back as late January towards early February. And this is how ratios can start to give us early hints that, hey, the technology stocks are doing great. The FANG stocks have recovered to a large extent, like names like Meta, Apple, Microsoft, and of course Nvidia, as Microsoft and Nvidia have benefited greatly from the optimism around artificial intelligence. While these stocks are doing really good, and the broader technology sector as a whole is on the up and up, Bitcoin is starting to lag. And this is not a good sign here, folks, because while it has still made leaps and bounds from where it was in November, I'm not going to sit here and discredit that, guys. Bitcoin definitely made some good moves over the past couple of months. However, the question you need to ask yourself is whether or not that's going to continue, even if you bought back in November or you're thinking about buying now. You gotta ask yourself, is Bitcoin still gonna be the leading horse in the race? Because what we saw here for the past couple months is very similar to what we saw back in price action. The same exact range here that used to be prior support in the last bull market is, as it was back here in May, acting as resistance. We didn't even come up here towards the upper band around 33,000 like a lot of people were calling for as their target to exit out of the market. It tends to be that people set their expectations too high to keep moving the goalpost, and eventually they don't take profits and get caught in, even if they got around the low range here, they eventually get caught in a trap, a liquidity trap, a relief rally. The 100% move we saw here from bottom to top, or if you want to look at it on the ratio perspective, right? We had about a 79% outpace of the Nasdaq during this period of time. Now we are starting to lag significantly to the Nasdaq, down 17.5% against its broader performance. Now, if we see over the next couple of days that we already got the red flip here on our key momentum indicator. That's not a good sign. That already is telling us that this trend is getting weaker. But outside of that, if we really can't hold on this line of previous resistance and make it new support, this is likely going to be a massive deviation that will eventually break down through there and continue all the way down to new lows. When will that be? Where exactly will it be on this line? I don't know. I'm definitely eyeing potentially the 1 point range here, 1-to-1 ratio, the Nasdaq and Bitcoin. The numbers are kind of abstract because the ratio at the end of the day, you're dividing like an index, index in this case by, you're dividing Bitcoin by some index. At the end of the day, the number doesn't matter so much. What matters here is that we're watching our trend line between the two prior lows. And given that this will take some time, this is the kind of range that I would look to go long here and look for that actual capitulative low in Bitcoin. When everyone is absolutely fearful, they've turned away from crypto. You know, it seems like there's no narratives or exciting things going on outside of a couple of builders building some exciting things, some of which we'll talk about a little bit later on. Key point here is that we want to buy when no one wants to, not when everyone wants to, not when everyone thinks and the big narratives that Bitcoin is supposedly this hedge that everyone's rushing towards, when in reality, the numbers don't add up. And the price action is starting to demonstrate that. We've been beating it like a dead horse over the past couple of months, guys. I'm not going to hide from it. We've been saying it for a long time, and that now is finally starting to play out here. And it's why we don't feel a lot of FOMO. Bitcoin's price is just a little bit higher from where we took our positions out back in August of 2022. And considering we were exposed to some altcoins during that period of time, it's paid us dividends to be out of those positions. Many of the altcoins in the broader market have underperformed and not moved up as much as Bitcoin has. So if you were in altcoins and you got out during that period of time in August, it was the right move for a lot of people. And once more, we've got to talk about what's going on in the macro scene, because this is going to lead us into talking about equities, and we need to really ask ourselves whether or not equities are going to be able to continue performing to the upside and providing a general uplift for all assets as a whole. Now, one thing that we have been talking about, and again, we stand out against, of course, against a lot of content creators. Most people are of the idea we're in a new bull market. The Fed is going to pivot, yada, yada, yada. You've heard the narrative. I don't want to go on about it too much. But a lot of people have constantly, as I mentioned earlier, moved the goalpost of how high the Fed has to take the federal funds rate, how much the balance sheet they have to reduce in order to tighten inflation. And as far back as a year ago, really basically back during the spring of last year, everyone was saying that, oh, the Fed will only raise the federal funds rate to 300 basis points, or 350 basis points, something along those lines. And we said for multiple months, almost coming up in a year now, that the federal funds rate is going to be well above 5%. Everyone thought we were crazy at the time. And yet again, month by month, as we just talked about before the last FOMC meeting, where some people still believed that the Fed wasn't going to raise rates a month out from that back in April, we were saying that the Fed was going to raise by 25 basis points, and they did. The same exact thing here is happening within probability markets. We're at the early stages before the next meeting, which is going to be on June 14th of 2023, right? So we're talking about almost 2 months out now. An entire month out from when we're going to have the next meeting, right? So right now, prediction markets are starting to show the exact same things that happened last time. What happened? Well, we see here essentially, and this is just to clarify what we're looking at here. This is a chart, and the percentages are displayed here on the left, as you can see on the screen. But essentially, we went from people back in 2022 estimating that essentially the federal funds rate would be around 475 to 500 at this meeting. There was general consensus. We had the bank crisis that was happening in March of 2023, where everyone really started to cut back expectations. But as the Fed addressed those issues and liquidity was provided and bank runs started to decline, then we started to see that those rates came jumping back up. And those expectations that 475 basis points or 500 where the Fed would start to cut, essentially, those have been tossed out the window. There is zero probability of that in the prediction markets. And now there's basically a debate between 500 to 525 basis points and 525 to 550. Now, the big thing I want to draw your attention towards is that purple part right down here that's been chopping here since April 19th at around roughly 28-30%. As of today, we have our biggest reading on that probability at 36.7% that we are going to get another 25 basis point hike. Now, it's still in the minority. It is still the contrarian opinion to have, but this is exactly what happened in the prior month. And if you are listening to the Fed, if you believe that the Fed's number one goal is to get inflation down to 2% and that they are going to get the job done ahead of schedule and they're not going to repeat the 1970s, you should be listening to what the Fed chairman, Jerome Powell, and other Fed board governors are saying at the moment. They are being quite consecutive in their messaging that they are going to have to raise rates further than people previously thought, and that inflation is still sticking the economy. I don't want to ramble too much about inflation, guys. I know it's a bit of a boring topic at this point. It seems redundant sometimes. Why are we talking about 25 basis point expansions in the federal funds rate, and what the Fed's going to do over the next couple of months? Isn't it all just kind of abstract in the grand scheme of things? Nvidia stock is going up. Bitcoin went up 100% from January upward towards April. Isn't it all just kind of abstract? Well, it's not abstract, guys, because these numbers, these incremental 25 basis point hikes, and the length that those expansions are remaining in the economy are going to be incredibly contractionary forces that are going to wreck consumer demand in the economy, that are going to cripple credit and crunch credit in the economy, making it very difficult to get loans, short-term credit that allows for business activity to flourish, for people to get richer and wealthier and therefore speculate on financial assets. And once more, it makes the cost to borrow more expensive, so people are going to borrow less to buy financial assets. All things that prop up the price of assets. Not to mention, if we're not engaging in quantitative easing and we're going to continue tightening the balance sheet, that's going to restrict the money supply. That's going to continue to contract liquidity and credit in the economy. And essentially, that is going to cripple not just crypto, but it's also going to cripple equities. We are starting to get towards our most overbought period of time for technology stocks since back during August. And if you guys remember what happened during this period of time, that's when during the FOMC meeting, Jerome Powell came in, he laid down the hammer, and he made it very clear that the Fed was on its task of getting inflation down to 2%, and that it was not going to pivot, and that this was going to take much longer than people anticipated. And what happened after? Those technology stocks that had rallied from June to August came crashing back down to new lows. Now, we are out of the technical accumulation channel here. We did the exact same thing here in late January and early February. The question is, as we are up in this range, can we actually hold it? Can we actually maintain above this range? Because every time we've been up here since over a year now, this has been essentially no man's land. There's no real foundation that actually holds price. And we have to ask whether or not this time is different. Is AI, this super awesome narrative that everyone's getting really excited about, is it really something that's going to sustain these valuations? Is it really justifying, even NVIDIA, who is at the centerpiece of making these GPUs, are they really going to be able to justify a valuation here of nearly $800 billion when in reality the financials are going to be nowhere near where they were in 2021 when valuations were at this range, right? If we take a look at those quarterly results, revenue is down a staggering degree here. We've got to ask ourselves also on the profit side whether or not NVIDIA is going to continue holding that when they've got tons of inventory still. And AI itself, it's just important to understand, guys, for those of you who have been hearing a lot about this narrative, if you want my take, while I am by no means, I'm not some absolute expert on AI. I probably wouldn't want to go to an expert on AI because people who are very optimistic on AI and spend all their time talking about it, they're of course going to give you an optimistic narrative. That's true in a lot of industries. But from a layman's term, I would tell you guys that while AI is very exciting, I've used ChatGPT, I've utilized Bard, all these technologies, I've used photo generation technology. There's a lot of really cool stuff in the AI space, and it has definitely made some major leaps and bounds over the last 2 years since I've really been dabbling with some of these tools. With ChatGPT and all these tools, while they are great, and it is definitely going to bolster productivity, it is not going to be some tool that just automates away everyone from the economy within a 6 to 12 month span. This is definitely going to be disruptive over the next 10 years, and I can understand why markets are starting to price some of that in, but it is not going to save NVIDIA if there is no demand for GPUs or people buying GPUs for gaming products. A huge segment of its business. Just take a look at its financials, right? Enterprise and cloud is great. ChatGPT is great, AI is awesome, but it's not enough to sustain these valuations. The same exact thing goes for Microsoft, the same exact thing goes for Apple, the same thing goes for Amazon and Google as well. These companies, while they're seeing some optimism here in the short term, AI is not going to be their savior because the vast majority of their business models do not rely on AI as a technology. And if those business models, whether it be advertising, whether it be consumer products, whether it be e-commerce, any of the things that supports these companies, if they are not tracking higher, if they are not showing the same kind of growth numbers that they showed in the past, the stock value will start to go down. These rallies, albeit in our mind, we believe they are relief rallies, they're short term, they will begin to start correcting lower, and we will start to see stocks sustain a longer term downtrend. Because the only reason these companies are trading at the PE multiples that they are at is because of expected growth. And if AI itself cannot start to deliver in the next quarter or two some absolutely astronomical numbers that are going to justify another 3, 5, 7 year bull market, these valuations are going to crater just as fast as they rose up. I'm not trying to be ultra negative, guys. I'm just trying to be realistic with you. There are incredibly deceptive relief rallies that can play out during bear markets. I want to show you guys a good example here. We'll just take it back to the dot-com bubble, right? Similarly in the way that the NASDAQ, after pulling back here a substantial amount, has started to kind of pull up. It's held up for a couple months. Let's just go ahead and take a look at the dot-com bubble, which again, moved at a much faster pace, right? We had a pretty substantial correction here from around 5,000 points down towards 3,000 with some really big moves here. In a single week, 18%, continue to move higher, holding up here. A lot of people during this period of time after recouping a lot of those losses, just down about 800 points, really in the grand scheme of things. Not much of a difference from those all-time highs considering the massive moves the NASDAQ had made. A lot of people were convinced during that extended period of time from April of 2000 all the way into September that it was the beginning of a new bull market. In fact, who could blame them? I mean, we were not only trending higher, we had what looked like a clear deviation double bottom here. We had 2 retests of this range here. Looked yet again like it was either going to be a breakout here or breakout here. But what happened after? For 2 consecutive years from September of 2000 all the way here towards October of 2002, we continued to bleed We continued to see the high growth speculative startups and companies that dominated the technology sector, from names like Microsoft all the way down to the small caps that went bust. We saw those valuations decline a whopping 73 to 75% from those all-time highs. A massive decline in valuation. Now, I'm not here to say that what we are experiencing now is going to play out exactly like that. I'm not here to say that we were in as crazy of a time as the dot-com bubble. Dot-com bubble is very different than where we are now, to be completely fair. But to say that this is going to play out like a traditional recessionary bear market, right? 2008, very similar pattern here. 2,800 points, 2,100. We came to 2,500, recouping more than half of those losses, and then we rolled over. You've got to be prepared for those scenarios, guys. Even if you're buying stocks, if you're speculating, making some short-term trades, that's fine. But preserving capital here is the essential step. And no amount of inflation or desire to get yield or protect myself is going to encourage me to take really risk-on speculative behavior. I'm much rather waiting for those lower prices. I'm waiting for real capitulation. I want to be positioned in the plays that are going to do really well. We can see that technology stocks are getting to, yet again, a relatively overbought stage that was previous support in the past, but is now starting to act as resistance like it did in August. We can see this by taking a look again at another ratio, the NASDAQ divided by the S&P 500. You guys can pull this up on your chart by typing in IXIC/SPX. Now, this is, again, one of many charts that we've been tracking within the Dash report. You guys get access towards our newsletters where we will go through, and also our exclusive market updates that we only send at the Dash report members from time to time. And we go through these kind of charts, some of which we just don't get to cover here on the channel. So if you guys are interested, check out the link down below in the description. That's a great way to support the channel and a great way to bolster your trading strategy. But generally speaking, we're going to be watching over the next couple of days, the Vanguard ETF here, VTI, coming up here in a range where we saw resistance back in February, we saw resistance back in June, we had a blow off top deviation here in August. This is the kind of range where we start to look to short, where prices are getting overbought, people are getting euphoric, they're chasing narratives. Perfect time to start building those shorts. So again, we're gonna be likely building those positions here in the near term. Now, one thing I wanted to go ahead and talk about here on an optimistic note is that there are some projects in the crypto space, a few select projects that we're actually interested in this market. That's probably been one of the biggest reasons why I believe this bear market is going to go on for a long time. There aren't many fundamental plays that could really reshape the industry, but there is one. They've been one of our long-term partners here on the channel, and they're one of the few projects that I'm actually looking to potentially build a position in as we're starting to enter in towards lower prices here for the broader altcoin space. Today I want to spend some time to talk about Radix DLT, or Radix Distributed Ledger Technology. Now, for those of you who have not heard about Radix just yet, we have been working with Radix for a long time here on the channel. It's coming up, I think, on a year and a half. I've been knowing about Radix as far back as 2018. I got to meet Pierce and Vilnius in Lithuania at a really interesting crypto conference, and they have been behind the scenes for years, multiple cycles, getting up to this point where they're finally ready here this summer to launch Radix's major awaited update, Babylon. Now, there's a couple details to know about Babylon, but essentially speaking, for those of you who are just hearing about Radix for the first time, Radix revolutionizes the way we think about building and developing decentralized applications through its native programming language, Scripto, which is asset-oriented. It's very different from the structure of what we see with traditional Solidity contracts. This allows for much greater degrees of security, simplification of developer code and interaction in building applications and deploying them. And on top of that as well, is going to allow for applications we just haven't even seen in the traditional Ethereum DeFi ecosystem, with higher degrees of scalability due to its consensus mechanism, Cerberus. Now, I gave a quick rundown there, but I definitely recommend you guys dive into the white papers, dive into some of the resources, check out the RadFi event that happened back a couple months ago. If you look up RadFi, RADFI, if you look that up on YouTube, you'll be able to find the presentation where Pierce and some of the other team members went out and presented on the vision for Radix. It is a good 45, 50-minute watch. I definitely recommend you take the time for it. It's totally worth it. But with Babylon coming out here in the summer, guys, you guys are still able to essentially get in on the ground floor, so to speak, either becoming a developer, becoming a participant in the ecosystem, whatever it may be. However you feel you'd want to participate in Radix, this is the time to be paying attention here. And it's not just me that's saying this. The price action alone has gotten really interesting, whereas a lot of tokens in the altcoin space have faltered since November. We can see here that Radix has more than doubled here from the lows, has been setting at higher lows and higher highs, building generally this kind of expanding movement from those highs and lows. And that for me is really exciting. But basically, this is all coming into preparation for Babylon, which is going to allow for the deployment of actual smart contracts on the network for projects to come out and launch their decentralized applications and really see the full power of both the consensus mechanism of Radix as well as the applications in real monetary transactions. And there is an already flourishing ecosystem that's utilizing crypto, deploying these blueprints and building really exciting applications. But if you are someone out there who is thinking about getting involved in learning crypto, you really don't even need to be a developer by trade. It will take some time if this is your first programming language. But being built around Rust, it's not only familiar to a lot of people, but on top of that, crypto itself is very easy to pick up. If you start diving through the documentation or you already are building or contributing within the ecosystem, there are some really great grant programs that they're doing at the moment that's attracting developers. For example, the Babylon Booster, which just was announced back last week, this is going to give around $10,000 of XRD towards a variety of different projects. They're planning to launch projects up until the launch. I think it's a couple weeks after the launch of Babylon to encourage ecosystem development. Now, this is not only a really great grant program, but on top of that, they're not just going to give you capital. They're going to give you a variety of different resources, people contributing. You can always ask questions, join the community. There's such an active ecosystem and a lot of great resources to get started. But Radix is always going above and beyond in actually trying to provide real resources for those who want to build within the ecosystem. I highly recommend you guys check out the website and check out the blog post if you guys are interested in learning about the grants program. But the big thing I want to let you guys know is this. For those of you, the broader range of you who are investors in this space, while I'm not here to shill Radix or tell you guys that you have to buy it, it is one of the few projects that we're genuinely interested in. There are very few cryptos that we have exposure to in this space, and Radix is one of the few that I want to continue building a position on. I want to continue getting more excited about Radix here. And if I have that free capital, if I get those discount prices, I want to start dollar cost averaging in heavier and heavier. So if you guys are not already, even if you're not convinced at the end of the day, if you don't agree with me or you don't know if Radix is really a project for you, I recommend you at least do this. If you are on Twitter, follow Radix. Follow them at Radix DLT, all one word. Follow Pierce. Pierce32, who is the CEO. Again, the individual I mentioned earlier who I've known for a long time. Pierce has been hard at work. He has been disciplined. Where so many people in the crypto space chase narrative after narrative when NFTs were a big thing, or crypto gaming, all this kind of stuff, GameFi, right? All these narratives that came up. Pierce and the team knew that DeFi was the focus point. This was the $1-trillion or multi-trillion-dollar opportunity for the crypto space. And if you aren't already following Dan, follow him over at Fuserler. I don't know how if I always mispronounce it and stuff, but basically Dan has been really the brains behind Cerberus, the consensus mechanism, and has been working on the team for a long period of time alongside Pierce. They've been around again far back beyond during the early days of Radix. So if you guys haven't already, definitely follow Dan. Dan Hughes is a good guy. The whole team is really an interesting group of people. They seem to have a really great energy around the product. They're not rushing things. They're looking to get it out right and do it right the first time. And for me personally, this is the kind of stuff I look for. I like picking up plays. I don't care so much if I get it at 3 cents or 5 cents. For me, I want to stack my bag. I want to get a position. And if there is going to be that next cycle here over the next year or two, as things get better, the Fed isn't tightening liquidity so much, things start to normalize, we go through recession. If Radix can make it through it, this is one of the few plays that I think has the ability to get up to the ranks of Cardano, of Ethereum, of all these major layer ones out there. And I think it's going to have the grounds to do a lot more when it comes to actual fundamental development and deployment of real valuable applications. So if you guys are interested, check out the link down below in the description. I rambled on a good amount there, but it is one of the few projects that I'm actually excited about here. And that's it for today's video. If you guys are interested in checking out some of the things we talked about, like the Dash report, check out the link down below in the description. Check out Radix as well. And I think the big thing to take away from this video, guys, is that, again, we want to look at ratios. We want to take a look at these measurements, because if we don't, if we just continue to parade the narratives that Bitcoin is this asymmetric asset, that it's a digital gold, and because we like it and we understand that narrative, that everyone else is going to follow it, we unfortunately will get caught in a position where smart money is moving out of the market. We end up buying at a high price, and we're left with bags that are down substantially, where a lot of people are going to either have to sell it themselves due to trading with leverage, or they get stopped out, or worse, you just have to sell it at a low price. You get emotional. You're holding onto a position that you don't feel confident in, that you might have been feeling sky high about when things were going well. We got to be contrarian, guys. We got to be in the camp that is contrarian and going against the trend here, because the trend is weakening. It is almost over, guys. It's almost there. We've been diligent, we've been in cash, and we're getting ready to make that big move to the downside here in the near term. So that's it for today's video, guys. Thank you all so much for watching. I hope you're all having a fantastic day wherever you are, and I'll see you all in the next video. Take care, everyone.